Let's talk about value investing. Let's welcome in a very special guest. Stephen Birch, president at William O'Neill, is now joining us from our studios. William O'Neill, if somebody doesn't know, has been one of the greatest investors, one of the top brokers, also known for introducing a strategy, Can Slim, and how to predict growth value investing. Stephen, thank you so much for taking out your time for us. Could you just first tell us what is value investing about, according to William O'Neill?
Well, investing in general, William O'Neill has written a book on investing in the United States, and it talks about his studies that he's made over the last 50 years, where he tried to identify those factors that were very common in great stocks. Some were value stocks, some were growth stocks. We really try to look empirically at the evidence, and so we've brought that research to India, and that's why I'm here today.
Right. What are the common mistakes in investing globally?
Well, very common. Globally, everyone makes the same mistakes. The investment community is made up of individuals that are driven by four factors: fear, pride, greed, and ego. And those factors affect us when we invest. So whether it's in Shanghai, Mumbai, New York, Tokyo, they make the same mistakes. The biggest mistake that we found is that most investors invest on tips and rumors. It's not based on any kind of empirical study or fact. It's simply what someone tells them to do. And so we try to educate and teach people to avoid that most basic mistake, which can be very costly.
Right. So how do you tell them to avoid them? So you've launched a software yesterday here in India. Can you just tell us what sort of data will it provide? How will it educate investors about how to invest, or at least give them data as to where to invest?
That's a great question. When people start investing, they tend to be very overwhelmed if they haven't studied the market or don't have a business degree. And as they get into it, they realize, wow, there's quite a bit I have to learn. I have to learn about financial statements. I have to learn about the news. I have to learn about the business in these industries that they may not be familiar with. What we did years ago was really harness the power of the computer to use quantitative analysis to help rate and rank companies. That really eliminates a lot of opportunities that might look attractive through a friend or a tip or a rumor, but we use the computer to give it a score. If it has a poor score, we advise investors to stay away from those names. If they have a high score, then we advise you to do more work. So our app, MarketSmith India, is a very powerful tool to help investors really understand and refine their process at stock selection.
Right. So, what is the database that you have? Are you going on with the top 200, 500 company? What is the sort of, things that people can explore?
The entire, all Indian stocks are in the database. This app has been in the United States for over 30 years. We've worked for about a year and a half localizing it to the Indian market, so it covers all Indian stocks. We collect the data, and our operations center is in Bangalore. So it's been designed and built by Indians. They understand the market, and we have a team of analysts in Bangalore that are helping our subscribers understand the general market, how to interpret and invest. So we're very, very excited about bringing this to India.
Right. You spoke about fear and you spoke about the greed. You think that, essentially that is something which the markets, need to do? I mean, that's something that investors need to win?
Fear and greed are what typically drive investors that are not sophisticated and haven't studied the markets. When you use a tool like MarketSmith, or if you have any kind of structured approach to investing, that will help you to control those emotions and be much more empirical and objective about your decisions.
Right. In terms of India, do you think it's a different market? It's been a growth investing market, so parameters may be different?
I just returned from a trip to China, to Shanghai. I got that same question. Isn't the Chinese market different? Aren't Chinese investors different? Aren't Indian investors different? We have offices in London, in New York, Boston, Shanghai, Bangalore. And we found that people are no different. It doesn't matter where they are in the world. We're all trying to make more money. We're trying to build wealth. And we all have human emotion that really drive our decisions. So the chart patterns that occur in stocks and the things that motivate people and drive them towards stocks are consistent across all markets.
Right. Can you just tell us that, as you pointed out, charts have interesting thing. Now, whenever you talk about value investing, or whenever any investor around the world would think about value investing, he would think about numbers, he would think about financial papers. So here you are mixing both. It's fundamental analysis as well as technical, probably to get an entry or an exit.
Exactly. I think we found that value investors tend to suffer from two common frustrations in the market. The first is they tend to really understand their companies well. They understand how to identify good value, but they often get in too early. We call that a value trap. Many of people have bought a stock and it's gone down and gone down. They've had to sit on a losing trade for months before it finally turns around and their value thesis plays out. So that's a mistake that many value investors make. And likewise, they don't know when to sell. And value investors are so tied up on, oh, it has a high multiple, or we think it's too expensive. And our studies are very behavioral. We try to guide investors by blending technical analysis in with our work to help them time their buy points and their sell points.
Right. So, how does it help? So, as you said, that, when a stock is going down and people know about it, it's been there for years, it has history, people have that temptation to buy. Mm-hmm. So, that's when you use charts to try and find that there could be more downside?
Yes, there are patterns that we've found that repeat themselves consistently over many, many cycles. And we try to teach people how to recognize these patterns because that increases the probability that you're buying at the right time. If you're in a name that is going down, we also teach money management rules. We advocate that you cut your losses. Every 50% loss started at a 10% loss. Every 50% loss requires you to double your money just to make back what you lost. Now that is very, very difficult for investors. And so if you let a stock, no matter how much you research and how much you know, if it is not moving in the right direction and losing money, and you're now down 50%, you've got a big challenge ahead of you to make that 100% gain. So part of our, on MarketSmith and part of our teaching and our education at MarketSmith University is to help people understand the money management, the portfolio management aspect of investing. You must protect your corpus, your principal, so that you can live to trade again. Investing is speculative. Everyone around the world is trying it. People have gone through various cycles. It can be extremely rewarding if you know how to master the game. So MarketSmith really tries to meld technicals, fundamentals, money management, and even more importantly, and you'd asked a question earlier about the Indian market, we also help people understand the broader market. Should I even be investing? There are times when the market's in a bear market, and you really should just stand aside. You should pull your money out, you should raise cash. We're big advocates of that. We don't advocate long-term 20-year holding periods because markets are cyclic. The Indian market, the innovation that's occurring here is shortening the cycles. Stocks are successful for a few years and then a competitor comes along. So I think that people that come and look at our package and experience and our software can see how we've taken the best from the United States, lifted it here, and packaged it for the Indian investor.
Right, but emerging markets, developed markets, always the same question, will they perform in a similar direction? Do you think the parameters that you've used in United States or any other developed market, will they actually work into India or China in a successful way?
That's a great question. We have a quantitative team in Los Angeles that tests each individual market, and we found that there's consistency across the globe. A lot of this is because we are really interconnected. We are a global economy. Yes, there are times when some markets become somewhat disconnected from each other, but we are a global economy, and if the world goes into a massive recession, everyone's going to be affected. Right now, we had signals that both in January and for both the U.S. and India, where we got very, very bullish. So our bullish signals for U.S. and Indian market remain strong. The U.S. market has come in a little bit in the last 4 weeks. It's corrected. It had a big gain after the rally. But we see consistency in these signals and these proprietary indicators, whether it's Shanghai, Mumbai, New York. It's human nature driving these markets.
Right. So that was about the technical parameters and what mistakes people should not make. But what are the fundamental things that you would look at? What are the sort of fundamental parameters that the software or any other company that you are investing in would look at?
That's a very good question because it gets to the core of what has O'Neill found to be relevant to investing. And I'll share a few of the factors. When we look back we have a database of over 1,500 great winning stocks, companies that we all wish we had bought. These are names that went up 2, 3, 4, 500%.
This is globally?
Globally, yes, right. We have it globally. And we found that the factors are things like accelerating revenue growth. You want the company you're investing in growing the top line. We see accelerating earnings growth. We see accelerating and expanding profit margins. It's a well-managed company. We see things like they usually have a new CEO or a new product. These are factors that we've detected before they make their big move. And that new product or new CEO is driving innovation in the company. We see that they may be in a strong industry group, and most importantly, they have the general market in a bull mode, right? If the market's going down in a bear market, 3/4 of the stocks tend to go down with it. So as you look at all these factors and make sure that they mesh together and you trade in harmony with the general market, you can really increase and improve the odds that you found a stock that has the potential to be a great winner. And so it's a structured, disciplined, quantitative approach, but it also allows the individual to use judgment, because you have to do some background research to understand what are you buying. It's not completely algorithmic. We have a model portfolio that we offer to investors to review, where our analysts assist them and they actually handpick and curate and find names to minimize the work for a user.
Right. So, as you said that for companies, you would look at the market size, the sort of, competition that is there, sort of launches that they would do. Mm-hmm. Just take an example of a two-wheeler space. Now, in India, there are about 3 different two-wheelers with decent amount of market share. Can all 3 of them be buy? Or, essentially, you would look at the topmost with the best market share and the best track record?
We would look, well, we're certainly interested in market share, but the most important thing is their revenue growth and their earnings growth. In China, it's the same thing. We have venture capitalists funding two-wheeler industries over there. The interesting thing is none of them have earnings growth. They're all losing money. So anything we buy must be profitable. And that cuts to the core of what we studied and found in our research. Stock prices over the long haul tend to follow earnings. They tend to follow earnings. If you own a company that's not making money, that's a problem. That is not an all-star name that has the potential to double or triple. So back to your question, in terms of the two-wheelers in the industry, we would really look at those that are growing their revenue, which many of them probably are, but are they doing it profitably? Have they managed it, and are they actually generating a profit, and is it accelerating? We like to look at the return on equity. We maybe prefer the one that has the highest ROE. Great stocks tend to have return on equities over 17%. We look at the management. We'd also try to evaluate the competitive moat. If anyone's a value investor or follows and studied investing from other gurus out there, a competitive moat is a critical factor to maintain that competitive edge and keep your earnings growing in strength. If that moat is being eroded by competitors, you have to be very concerned about the sustainability of the company's earnings.
Right. So sales and profit are, of course, the important thing. Let's go back and go to the assets as well. So how important is the balance sheet? Does ROE capture everything in the balance sheet, or does it look at debt and capex also quite significantly?
We do look at the balance sheet, but we found that when a company is in a growth mode, even if it's a leveraged growth mode and they are carrying debt, the market will not penalize them for carrying debt, so we're not as concerned. Most of our factors are on the income statement. The ROE does give you a good read on the company's ability to manage their profits. So no, the debt and heavily debt companies that are very cyclical don't tend to come up on our model portfolio as much, because they're usually big lumbering older industries, airlines, maybe mining, and so on. So that's not a big focus for us as the balance sheet. It's mostly, as you mentioned, revenue growth and earnings growth.
Just another word on balance sheet. Are you surprised by the change in the trend that are seen for tech companies? So earlier it was about debt, what we were talking about, and which companies are taking debt. But now it's about record buybacks, which is also increasing their ROEs. Do you think that is something which is changing?
That ebbs and flows. That has changed. That doesn't really concern me. I think that what concerns me is when a company is losing their innovative edge, and the only way really to deploy their capital is to buy back stock. That is a concern. And that happens, though, when companies are successful and they are sitting on large cash piles, and the CFO has a responsibility to think about how to deploy that money. But I don't see that shift as being a fundamental concern.
Right. Let's talk about the US markets and the global equity markets as a whole. A lot of countries are now essentially becoming very protectionist about their industry, about their people. What sort of liquidity will they provide to their market? Do you think that is changing the trend of global trade worldwide? Is that important for markets? Because all of it started in 1970s, when you actually saw things getting freed up for different markets.
That is important, and I think that is a question that many people are grappling with. There is a shift, a noticeable shift in the United States. Now, much of it is more, I'd call moral suasion, with President Trump really espousing a certain philosophy through his words and what he says. Now, in terms of actual implementation of these more restrictive or protective policies, that remains to be seen if he can actually do that. Every country, it's interesting, we are interconnected. We do need to be aware of jobs in our own nations, but we also want to move forward, right? So some old industries that are being destroyed through competitive or capitalist destruction and really are on the way out, it's difficult, it's hard. But then you have young, new industries with young people coming in and innovating. So I think it's going to be a topic going forward. We're going to have to sort of walk that tightrope between protectionism and open trade. And I think dialogue about it is good. We really have to continue to talk about what's good for everyone. It's really about a dialogue and a compromise.
Right. Also about what's happening with central bankers. So in the last 4 years, or maybe since 2009, the focus on central bankers and what they are doing worldwide has increased quite a bit. You think that is also shifting to policymakers, at least in the last 1 year that has happened?
I think the policymakers would like to have more influence. I think sometimes they do. I think that there is a concern about whether the central bank should remain independent. I see that as just part of the process. There are checks and balances in place. The press does a good job at reporting on some of these conflicts or these pressures. So I don't see that as being really corrupting or systemically an issue. I like it when they're in sync and there's good dialogue. So I don't see that as a real serious issue going forward.
Right. In terms of United States, what would you expect from Fed? Do you expect a sharper than expected increase? But that would only happen if earnings grow, which means there would be still a lot of liquidity in the market?
I don't expect a sharper than expected. I really think that the Fed has been pretty diligent at being methodical about raising rates. I think the consensus now is they were expecting 3 rate increases this year. Now some people are talking maybe we don't get this tax reform through, maybe the economy doesn't really catch, maybe it's only 2. The fact is we still have low rates in an absolute sense in the United States, so there's still good, robust growth ahead of us. We hope to see some growth through the GDP. The Fed's going to control that. They are going to respond, and they're going to do it methodically. So I think that's generally accepted that we're in a rising rate environment. But remember, rates are still, in an absolute sense, very, very low from historical standards. And
what does that mean for equity assets?
Well, that means that financials, which were really out of favor and which really turned after the election, they had a good run and they got ahead of themselves. Many of the regional banks, the ones that have variable rate loans and are most sensitive to changes in interest rates, those in the last 4 weeks have now come in a bit in the U.S. market. You even had some Indian banks at the similar time moving. Many people are now questioning, hey, is that it? Is that all we have? From our technical indicators on the regional banks, they actually still look very constructive. This was a normal correction. It's nothing unusual. The stocks are now building trading ranges at new levels, and we're now approaching earnings season. So as we get this next quarter of earnings out, we'll see if valuations got too stretched. If they did not, and if the good, well-managed banks that have a good portfolio of loans are benefiting from this uptick in rates, they should go higher. The market will anticipate, okay, another quarter ahead, Fed's going to come out, they're going to raise rates again, and those banks will benefit. So still very bullish. I think I like the sector. We've been watching it. It would be very rare for those financials to have a 3 or 4 month run and then top out and that's it, and they're going down. So the financials look like they still have more room ahead of them.
Right. In terms of financials or any other stocks, which have consistently delivered numbers, how does the software predict the earnings going ahead? Does it take the consensus numbers or do you build in your own numbers?
The software has no predictive ability on estimates. We will use consensus estimates. We will get those from a vendor. The software really looks at historical earnings, and we also tie that to when the stock has been, when it broke out and started its big move. We know historically from studying great names that when a stock really in its sweet spot of its growth cycle, it will move 15 to 18 months. And that's not very long. So if we have a stock that is maybe 12 months into its move, it's gone up 200%, we know it's in a late stage of its growth period. We pay close attention to every earnings release. If earnings start to decelerate, if they are going from a double-digit 25% year-over-year earnings growth rate down to a single-digit 6% or 9%, that's a problem. But we don't do any forecasting or model building to try to anticipate, but we do look at analysts on the street. We try to gauge, we look at estimates, whether they're being beaten or whether they're coming in light, but forward modeling is not part of our process.
Right. Just a word on emerging markets versus developed market. Last 3 years, developed markets have done well. Select emerging markets have done well. Do you think that emerging markets will get the flow that they were seeing earlier between 2004 to 2008? Do you think that sort of a flow is possible into emerging markets?
I think so. I think, longer term, you've got to take a long view on emerging markets. There's so many bullish demographic factors here that would indicate that it would be foolish not to pay attention and look for opportunities there. I'd also say that rather than play an ETF or a broader market index, we really advocate bottom-up stock picking. We really advocate, if you're going to move into an emerging market, find the best of breed, the best ideas, and typically, even if that emerging market goes down or goes into a slight correction, your best managed companies, the ones that have that accelerating revenue and earnings growth and expanding margins with that innovative product and that competitive moat, they tend to go down less. And when the market turns, they will rebound very, very strongly. So let bottom-up individual names guide you on where you should be across the globe. That's how we operate, and we're very agnostic. We don't say we have to be in a particular market. We let individual names tell us. In India, we're very excited. We have a model portfolio that has several names in it, some banks, some cement companies, aluminum, a variety of industries. In the U.S., our model portfolio is very heavy on technology right now and financials. So there are opportunities all over the globe. There are people continuing to innovate and be entrepreneurial, and it's really our job to find those individual names.
Steve, thank you so much for taking out time for us. Always good to get a perspective from you. That was a perspective on value investing and how to look at stocks and individual sectors in India.